Good morning, everyone, and thank you for joining us today. My name is Brandon Rekshosky, and it's a pleasure to welcome you to today's webinar, Rate Cuts Are Back, Where to Find Yield Now. As we all know, the Federal Reserve's recent shift from tightening to easing has reshaped the income landscape. After several years of higher rates, many investors are now asking a familiar question: where can I still find attractive yield opportunities as policy rates move lower? In today's discussion, we'll explore two unique areas that continue to stand out for their income potential: business development companies, often called BDCs, and mortgage REITs. Both have historically offered compelling yields and can play a unique role in diversified income portfolios. Over the next 30 minutes, we'll unpack what's the Fed easing cycle and what does it mean for income-focused investors, how high-yielding BDCs and mortgage REITs can help offset falling rates, and why diversification across these two segments can make sense throughout this environment. I encourage you all to ask questions throughout today's presentation. You can do so in the Q&A window in your screen. I'll now turn things over to my colleague, Coulter Regal, who will take a deeper dive into these strategies, discussing how VanEck's BDC Income ETF, ticker BIZD, and Mortgage REIT ETF, ticker MORT, are positioned to help investors access these opportunities. So thank you all again for joining us here. And with that, Coulter, over to you.
Fantastic. Thank you, Brandon. Appreciate the intro. And before we dive into those two segments, mortgage REITs and BDCs that you had sort of alluded to, I wanted to kind of take a pause in here and just take a moment to kind of recognize where we are today and where many investors are positioned coming into this year and leading into the next year, and where we find ourselves and how that might change going forward. So I think this is a really great chart to kind of help illustrate where many income investors today have sort of been finding yield or income from their portfolios. This is a chart that shows, about the last 10, 15 years or so of money market funds, and the total amount of money within these money market funds, which essentially are, cash-like short-term treasury positions that offer, yields to investors for very low, essentially risk-free, measures of volatility and risk. Over the last few years, income investors have really enjoyed, quite a nice short-term rate curve where we've seen, the interest rates on short-term treasuries, really quite, increased rapidly over the last few years. We went from basically, near zero rates, prior to 2020. And now over the last couple of years, we've seen rates kind of, in the 4.5% range and even as high as 5%. So naturally, that type of higher income environment for short-term treasuries leads to an attractive income play where you can receive 4.5-5% yield on short-term treasuries. And so we've seen many investors kind of crowd into that space. So over the last, call it 5 years, we've actually seen the amount of assets in these short-term money market funds more than double, from about 3 trillion total in terms of assets under management to now we're sitting at a record 7.5 trillion. So, the question now is, with all of these investors sitting in these short-term money market funds, as we shift into an easing policy and cycle going forward, what does that mean for these investors and what does that mean for their income portfolios? So I think a great way to help illustrate that is, looking at the rate curve, more recently here, and this is really just a chart of the Fed's, federal funds rate over the last, call it 5 years or so. And you can see, as I mentioned, we really had quite a drastic increase in rates. We came off this near zero bottom floor in end of 21, and into 22 we had, one of the more aggressive rate hiking cycles that we've seen in really the last decade or two, where we reached, approximately 5.5 in terms of the federal funds rate. And so that was, as I mentioned earlier, the impetus for many investors, finding really attractive low risk yield from those money market funds. But now if you look more towards the right-hand side of this chart, you'll see we've actually started to kind of come down a little bit. And, the first rate cuts sort of along the cycle were really about a year ago. Last year, end of 24, we saw a couple of rate cuts, and then we paused for about 9-10 months. And then just now, most recently, beginning again in September of this year and again in October, we've seen rate cuts. And I think that many investors, if you had asked them back during the beginning of this rate hiking cycle, how long they thought we might have stayed at elevated rates, I think many would have thought we would have today been at a much lower a much lower rate. So this has really been sort of a sticky and longer than expected rate cycle, but it now does appear that we are finally beginning to sort of round it out a bit and start making our way down in terms of easing rates. Inflation's come down, and now the Fed is really taking a kind of an approach more towards the employment side of their mandate. So beyond inflation, the Federal Reserve is also sort of in charge of monitoring employment and trying to maximize that. So as we've seen announcements of layoffs here in the last couple of months, I know Amazon was quite a notable one with tens of thousands of employees planned to be laid off in the next year or so. And so I think the Federal Reserve is starting to at least pay more attention to that. And so you'll see, I think, going forward, rates I think likely are to come down. And I think if you look at some of the commentary out of even our current administration, I would say that President Trump is not shy in being vocal of where he thinks rates should be. And so obviously he's been voicing his opinion there. And if you go back to even the rate cuts in September, the sole Fed committee member who dissented and opted against the 25 basis point cut was actually Stephen Myron, which was President Trump's appointee, and he dissented because he actually wanted a 50 basis point cut. So it wasn't that he didn't want a cut at all, is what he actually wanted more significant cuts. So what does this mean? I think essentially as rates come down and income investors will have to take a look at their portfolio and start considering what kind of other asset classes are out there that I can use as a tool within my portfolio to help replace some of the income that I might be getting from, say, a money market fund as those rates come down. And two of the areas that we are talking about today and many investors are taking a look at stand out quite a bit in terms of their yields, and that's why. I mean, they are great tools to add into your portfolio to help sort of replace income as rates fall. And those two areas are, one, mortgage REITs, which you can see here on the far left hand side, are offering a very attractive 13% yield right now. And the other asset class that we're talking about more and more are business development companies, which are essentially tied into the private credit market. They lend to small and medium-sized private companies. And so these are two areas of the market that both can provide, double-digit yield potential. I think this really stands out too, because if you look towards the right-hand side of the chart, where you can see many of the other sort of standard, income option and income assets that most investors will, find in their portfolios, as you move up the curve a little bit, from the 10-year yield of about 4.1, which is just slightly higher than the current short-term treasury rates. We have a very flat curve. I'll get into that in a little bit. But even if you move up and you're looking for yield elsewhere, even going to something as simple as investment grade corporate debt, you're really only getting 50, 60, 70 basis point increase in terms of yield. So you're taking on a little bit more risk, not really getting compensated for it. And furthermore, if you move up even beyond that from investment grade to high yield, you get more yield, certainly. But I think as people sort of look to expand their portfolios of their income sleeve, I think BDCs certainly have been a big topic lately, as private credit has opened up to many investors who haven't had access to it in the last decade plus. But more and more mortgage REITs as well, as we'll get into it a little bit. The dynamics around the mortgage REIT business model is one that may potentially benefit from sort of the expected shift in rates coming forward. So with that, before I get into that part of it, I kind of want to just touch on the mechanics behind mortgage REITs, because many people have heard of real estate investment companies and they have an idea of what they are, but they might not have necessarily heard of mortgage REITs specifically, which is a part of the real estate investment trust market, but it's a little bit different. Most people, when they hear a REIT, they think of your typical REIT, which owns a physical property, will collect that rent, and then distribute that rental income to the shareholders of the REIT as dividends. Mortgage REITs are a little bit different. Mortgage REITs essentially manage portfolios of mortgage assets instead of physical properties, and they generate income. So think mortgages, mortgage-backed securities, commercial loans. They'll generate income from those mortgage assets and then pay those out to their REIT shareholders. So it's a little bit of a different, business model than what many people might sort of traditionally think of when they hear the word REIT. But I think I'll kind of walk through some of these steps, but I've got a few key phrases here underlined, so pay attention to those. And I'll circle back on those in a little bit. But to start, mortgage REITs essentially they raise capital through a mix of equity and debt. But debt, I think, is a key aspect here. Is the primary source of their funding. Typically this debt is short term, oftentimes through repurchase agreements, and so that debt is really what will fuel much of the funding and the financing behind the purchasing of those mortgage assets they hold. And that kind of ties back to leverage. So, many times these mortgage REITs will be levered up several times, 3, 4, 5, even up to 7, and beyond in certain cases. And so, the debt element here is really is a key element that I'll circle back on as well. But just know that mortgage REITs, most of their funding comes through short-term borrowing. So they take that short-term borrowing and then they buy longer-term, longer dated mortgage assets. So if you think about your typical mortgage, it's typically a 30-year fixed is a very common mortgage, and if not, then a 15-year. So these are much longer dated, assets, and so you'll get differences in terms of the interest rate that you earn on a long dated asset like a mortgage versus the funding cost of a short term. And so it's that difference in the short term funding and then what you earn on the long term mortgage asset is essentially the income that these mortgages are earning. So they're earning the net interest margin between their borrowing cost on the short term versus what they bring in on the long term from their mortgage assets. And then of course they'll take leverage, that borrowing that I mentioned earlier, that debt, and they'll use that as a way to amplify the net interest margin that they're earning on that net, that essentially that spread between short-term and long-term rates. And then of course, I think another key aspect here is REITs, as part of a REIT, they are required to pay out at least 90% of their taxable income. And that gives them, a unique tax advantage in the sense that it allows them to avoid sort of your typical corporate level tax. And so, as a means, so they really are quite, set up to distribute income out to shareholders. So essentially they're borrowing short, buying mortgage assets in the long term, earning a spread on those borrowing costs versus what they bring in, and then leveraging that up through debt financing and distributing it out to shareholders. So how does that play out when you look at yield curves? And as I mentioned earlier, I highlighted some of the short-term and the long-term key points on that previous slide because it really does matter. That is sort of the primary income function of these mortgage REITs. And so I think this is a great chart to sort of illustrate where we are today, where we've been in the past, and perhaps maybe even where we'll end up in the future. So this is simply just a chart of the Treasury curve all the way from 1 month up to 30 years. And it gives you a representation of where we are in the curve and how steep or how flat the curve is, today relative to history. So at the very top, you'll see the purple line, and it's quite a flat yield curve. That is actually today's yield curve. So where short-term rates are around 4%, and long-term rates are only just slightly higher at about 4.5%. So this is, as you can imagine, when you're a business that's essentially earning the spread on those short-term and the long-term rates, this is sort of a challenging environment for mortgage REITs, or it has been historically the last couple of years. But I think if you look at sort of, the typical yield curve and where we've been, historically, these 3 other curves here that are below it that are much steeper are essentially just snapshots of the curve from 5-year increments, so 2020, 2015, all the way back to 2010. And you can see, it's much steeper, and this is sort of their standard yield curve. So I think where we sit today in this very flat environment, relative to where we've been typically, I think is a great illustration of where we might end up going forward as we see more and more rate cuts, from the Federal Reserve, going forward for the next year or two. You would expect that those would bring down the short-term borrowing cost and steepen this yield curve a bit, which should be supportive of the mortgage REIT business model, where they're earning that spread again on the short-term borrowing cost versus the longer-term mortgage assets. But of course, with high yield, there obviously comes a risk that investors should be aware of as it pertains to mortgage REITs. So they do offer high income, but that comes with trade-offs, and understanding those are important. So really the main risk that tie into mortgage REITs revolves around interest rates, as they're very sensitive to those moves, and as well as borrower behavior, and as well as how easy it is to maintain their funding and their short-term borrowing. So, I think interest rate risk is obviously is a very big one, considering, they are earning essentially income based off of the spreads. If there's any significant movements in interest rates, that can, either positively or negatively impact their net interest margin, as well as also the book value. So they hold loans and mortgage-backed securities on their balance sheets. And as rates move, that can, impact the book values and the valuations of those particular holdings as well. And then of course there's leverage. So as I mentioned earlier, predominantly the funding for mortgage REITs comes from debt, short-term borrowing. And so if there is any sort of significant or volatile or unexpected move in rates, that can really be magnified through the use of leverage for these vehicles. So it certainly is worth being aware of that. And then of course prepayment risk. That's one thing that probably most people are familiar with, at least. When you think about your typical 30-year mortgage, and many people over the last couple of years have bought homes and have a mortgage rate in upper single digits perhaps. And as rates come down, if those longer term rates come down somewhat enough, they would be incentivized to essentially refinance or to pay back those loans sooner than expected. And then that would result in the mortgage REITs having to reissue that cash into perhaps lower yielding mortgage securities. So as rates come down a little bit in the longer term, that can result in some prepayment risk. And then of course credit risk is one that many are probably most familiar with. But as it relates to the mortgage REIT environment, many of these REITs do own some exposure to commercial mortgages where they can. And so they can take on borrower credit risk of the mortgage for those commercial loans. You see some non-agency exposure as well. So these would be your typical, residential mortgages that are, non-conventional, and so not necessarily backed by your government-sponsored agencies like Fannie Mae and Freddie Mac. So in the extent that they, these mortgage REITs, have exposures beyond your agency mortgage REITs, there could be some credit risk as well. And so I think another important part of sort of the risk amongst mortgage REITs is just simply the fact that there really can be quite a broad difference in types of strategies that each mortgage REIT can undertake, in the types of assets that they own, whether it's mortgages or commercial, whether those are agency loans or non-agency loans. Some even operate within sort of the mortgage servicing side of things, so they'll have a little bit more stable income, but perhaps that could mean lower yields. And so really, it comes down to what assets they own, as well as how do they manage their interest rate risk. So as leverage, I mentioned, as a big part of the business model here, they do a lot of hedging around the sides to sort of ensure that they're not, giving up too much risk and volatility. They try to smooth it out as much as possible, but that leverage has cost, and how they implement that can also, dictate the volatility and total return of each individual vehicle. So, I think all of this simply means that there are many REITs out there with varying strategies. And so, I think it really kind of points to you either have to be sort of a financial investigator and be willing to dig down into all of these various mortgage REITs if you're looking to invest in them, to identify, the risks associated with each, or you can take a broad, basket approach that diversifies the exposures of all the different REITs out there, and you can own the industry rather than owning a handful of different REITs that may or may not have differing return and volatility profiles. So I think the key risk here is that many of these mortgage REITs, they do have complex businesses, and they can be difficult to sort of analyze. And so I think that really helps speak to the need for diversifying across the industry. And so I think this chart helps illustrate that. Essentially, each little blue dot is a mortgage REIT, and they can all have very different returns and volatility profiles. It shows the 3-year annualized, return and volatility of each of these. And then you have, in the orange dot in the center, is VanEck's product, our VanEck Mortgage REIT Income ETF, or ticker MORT, MORT. This is essentially the broad basket approach. And so you can see here that it really gives you a nice way, single access to access the whole industry as one ticker, and you can help diversify all of this risk that you see across the various different types of mortgage REITs out there. So I think, as we talk to investors, many aren't necessarily, financial analysts themselves, and so, or don't have the time necessarily to dig into all these different mortgage REIT businesses. And so they oftentimes will use a broad basket approach like ours, more to access the space and really kind of, get what they want. They're wanting the they want the income associated with mortgage REITs generally, but they want to be able to smooth out the risk of each individual mortgage REIT, across the industry as a whole, and really kind of key in on the income rather than sort of the idiosyncratic differences between each, mortgage REIT. So our product, Mort does just that. It tracks a passive index, owns 90% of the mortgage REIT market, and it gives you that one ticker access, broadly diversified across the whole space. And as you can see here, it has a very attractive yield of about 13%, with a pretty modest management fee as well.
Coulter, that's great. Maybe jump back to the mortgage REIT slide here, because I want to use this as an opportunity to remind everyone you can ask questions. We've gotten a few in, and I think it's worth probably pausing on the mortgage REIT conversation and asking just a handful of these questions, because it's probably an asset class that I would imagine many investors are not familiar with, but it is clearly a high yielding asset class. So I got one question from Michael that I think is worth touching on, because you alluded to some of the dynamics within the mortgage REIT industry and the fact that many are managed in very different ways with different exposures, both residential and commercial. So Michael asks kind of the mix in terms of Mort and its exposure to residential versus commercial. And then maybe you can talk about the different ways that these mortgage REITs invest. There's investing in just mortgage-backed securities, generally speaking. There's also loan origination, mortgage service rights. You alluded to that, but because the question kind of touches on the loans that are held by some of these mortgage REITs, are they junior or senior? I would venture to guess they're probably more in the camp of mortgage-backed securities as the bulk of the exposure. But talk to the residential versus commercial, as well as the structure of the securities that they're generally investing in.
Yeah, absolutely. That's a great question. And it's a question that, we do get quite frequently, because, as I mentioned earlier, there are varying types, and, most people think of residential mortgages, but commercial is also a big part of it. And for a few years, that's been a part that people have kind of keyed in and had some interest in. But within the broader mortgage REIT real estate, and within more specifically, our portfolio, about 2/3 of it is sort of associated with mortgage REITs that sort of focus on the residential side of mortgage assets, owning both agency and non-agency residential mortgages. And so that remaining 1/3 would be your commercial exposure, or even mortgage REITs that have exposure to both. They can be multi-type mortgage REITs where they have exposure to a little bit of residential, a little bit of commercial as well. So, but in the grand scheme of things, typically about 2/3 of the portfolio of Mort has exposure to sort of residential focused REITs, and 1/3 being commercial or multi-type. And then, yeah, absolutely. I mean, mortgage-backed securities tend to be sort of the bulk, I think, of the holdings for most of these sort of residential, mortgage-backed securities or mortgage REITs. But they do also, and they can also issue loans themselves, as well as mortgage servicing. Right, they can actually purchase the rights to service many of those mortgages, which gives them a little bit of an alternative income stream, a little bit more stable, perhaps less sensitive to interest rates. They essentially collect a fee. It's a fee-based revenues stream, but they really can have quite a varying degree of asset exposures. And of course, on the commercial side, many of these can issue loans directly for commercial buildings, and some of those might even focus on certain industries. They could focus on office space or industrial or data centers. So some might have a mix of that as well. So many of these strategies, they can either be focused or they can be broad, but there really is quite a bit of variety within each of these assets in the portfolios themselves.
Okay, then one more quick question on this came in from Nico in Florida about the distribution characteristics of mortgage REITs. Well, I guess from a tax perspective, what are the characteristics typically for mortgage REIT income payments?
Yeah, it's great. It's a great question. So ETFs in general are pass-through wrappers. So any shareholders of our ETF Mort, essentially we would pass along the tax characteristics that the underlying mortgage REITs themselves distribute. But by and large, the mortgage REITs themselves, their distributions are typically ordinary income. These are interest on essentially interest on mortgages, and so that passes through as ordinary income. But they do have still the capacity to pass through capital gains and even sometimes return of capital. So it can depend really on sort of the year, and if they have book gains within their portfolio that they need to distribute, they will distribute that out, and that'll of course be passed through to the end shareholder of Mort. But predominantly it's ordinary income, but you should still expect to see at times some capital gains in there, as well as potentially some return of capital.
Okay. All right, great. We do have a few more questions, but I'm going to come back to those so we can move on to the second leg of our discussion. And this is probably an area of the market that everyone has heard of because became a very in vogue topic, and that's private credit. But specific to this conversation, we're talking about a very dedicated and unique vehicle to provide investors exposure to private credit. That's business development companies. So Coulter, take it from here. Educate us and tell us about the opportunity in this area.
Yeah, I just want to first start off by kind of highlighting the fact that as you mentioned, private credit over the last couple of years really has been something that's perhaps more on the radar of many investors rather than a little bit more so than perhaps mortgage REITs. But they're both high yielding, and private credit has really kind of burst into the scene the last 4 or 5 years, and I think this is a great chart to help illustrate that. So this chart shows the assets under management of BDCs, or business development companies. These are basically investment companies that lend to direct middle market lending to small and private companies. So they're bespoke bilateral, loan agreements, essentially helping finance, the small private companies of the U.S. And so you can see here, over the last, 5 years, we've gone from about a little over 100 billion in terms of total assets under management for these BDCs up to in excess of 500 billion. So I think, opening up the doors, this has historically been an asset class that many investors have had a difficult time, reaching and accessing within their portfolios. But business development companies, specifically publicly traded business development companies, really do kind of help open up the doors and provide investors a way to gain exposure to private credit in sort of a vehicle that provides, I think, one key element that you don't typically find in the private credit market, and that's liquidity. So there are some non-traded BDCs that you can purchase and own, and they offer redemptions quarterly. But specifically what we're talking about here today, and what our product, the VanEck BDC Income ETF, offers exposure to, is the publicly traded shares of BDCs. And so that gives you a key element. You can trade them on an exchange just like any normal stock. And so that allows you to move in and out even intraday if you so choose. But really what the primary benefit of what many investors look to private credit for is obviously the high income potential. Middle market loans tend to come with spreads that can be 500 to 600 basis points above the current floating rates of today. And so that is ultimately leading to yields of double digits today. 11-ish% is what we're seeing right now. And I think the main thing here to mention here as well is that the majority of these loans, about 80% or even more, are floating rate. So they will float up and down a little bit with sort of the predominant short-term rates, but you still get a very nice, attractive 600% or 600 basis point spread on top of that as well. So that's where the majority of the yield comes from. But ultimately, BDCs allow investors to access private credit, gain private credit like exposure and income, but through a liquid vehicle that is publicly traded on an exchange, and allows for liquidity as frequent as intraday if investors desire that. But as I mentioned, the floating rate feature of these middle market loans is something to be aware of as we kind of move into a cutting policy going forward. That ultimately could be a little bit of a headwind in terms of income from these BDCs, but I think rates going forward still will probably be above where we've been the last couple of decades, which have been very low rates. And so historically, the average yield on these BDCs, even in very low environments, is still very attractive. So over the last 15 years or so, the average yield on BDCs as an industry has been about 9.5, 9.3 is what I'm showing here on the slide. The last couple of years, as rates have gone up, we've actually been a little bit higher than that. So we've been almost 12%, I think, sort of the last 2 years has sort of been the average. We're a little bit lower than that today after a couple of cuts, but I would say that even if rates come down a bit, BDCs are still an area of the market that will offer a very attractive yield. And I think also importantly, it's differentiated, it's alternative source of yield. Many investors today, their income portfolios are traditional debt, corporate, high yield or investment grade, and some treasuries, which are fixed rate instruments. They have a duration risk, so as rates move, they can move inversely to those rates and create risk. Floating rate vehicles like BDCs or private credit loans, give you high yield and an alternative source that they're as floating rates. They kind of don't have that same duration profile as your sort of fixed corporate debt. So you get the high yield and you get diversification benefits along with that relative to sort of your traditional income portfolio. But like mortgage REITs, BDCs are very complex vehicles, and the strategies amongst each BDC can vary quite significantly as well. So some BDCs may focus on certain industries like technology, for example. Others might be more diversified across various business segments. Some might focus more on, debt-focused lending. Others might focus a little bit more on, taking equity ownership of some of these, private companies. So you can really have quite a drastic mix in terms of the exposures, within each of these BDCs and their portfolios of middle market loans, as well as, some equity exposure within those companies themselves. And so that can, of course, result in varying degrees of, returns and volatility. So the story is much the same with BDCs as it is with mortgage REITs. It really does take a bit of time and effort to dig into each of these various BDCs and their specific business models, their underwriting standards, their asset exposures, and to understand where that might lead you. It's it can be challenging to select a handful of these BDCs. So that's why we view a broad basket approach, much like what we have in Mort, is an appropriate way to sort of access this space. It gives you a one ticker access vehicle to gain exposure to the whole industry, rather than having to select and maintain sort of a roster of of a handful of BDCs themselves. And so our product, the VanEck BDC Income ETF, or ticker BIZD, is a great way to do that. We've been in the market for over 10 years now. We launched back in 2013. We have about $1.5 billion in terms of assets under management. So we really are sort of that main passive industry broad exposure to the BDC space, that really allows investors to gain exposure and the income potential of private credit through these BDCs, in a diversified vehicle that is a long history. So you can really go back and kind of monitor how it's performed through various interest rate cycles and environments. But ultimately, this is a segment of the market that many investors are now beginning to look at more seriously, and we're seeing some support as well. The administration trying to open up the doors for alternative investments in general, to be more open to investors as a whole. But with that, I think one more important part, to sort of mention with BDCs is sort of the near-term volatility. I'm sure perhaps many of you have perhaps seen some of the headlines about private credit over the last month or two, and some concerns around, some cracks in the credit market perhaps. But that ultimately, I think, has led to somewhat of an opportunity, within the BDCs, particularly. BDCs, at least the public traded BDCs, are uniquely positioned in the sense that they, are eligible to be sold sort of intraday on the exchange. So that has, provided some liquidity, premium and perhaps double-edged sword as well during times of concern that leads to many investors sort of using them as a release valve, or liquidity release valve, if you will, where they can actually sell these publicly traded BDCs in the market, while many closed-end funds that offer private credit exposure, the redemption process is a bit more drawn out, and less liquid. And so BDCs have sort of taken a little bit of a haircut here over the last month or two, around some broader concerns, around credit, and if there's a late cycle environment, and so that's resulted in a sell-off in many BDCs. So for those shareholders who are out there who might own individual BDCs, I think now might be an interesting opportunity to at least look at what you own, and assess whether or not there might be a tax loss harvesting opportunity there, coming into the end of the year, and looking for ways to sort of harvest some of those losses, if you have any, and redistributing into perhaps a broad diversified vehicle like BIZD is I think a great way to sort of take advantage of sort of the near-term volatility that we've seen in BDCs. But I would also say that while many people have been concerned over the last month, they've seen, I think, Tricolor and First Brands of some of the automotive loan companies have sort of had some issues with their loans. Those predominantly haven't necessarily been in the BDC space. Those have been primarily bank owned. So, but BDCs have really kind of taken the brunt of sort of the headline risk, if you will. So whether it's warranted or not, perhaps oversold or not, or overblown, I think regardless, the fact that BDCs have kind of taken a little bit of a haircut over here could open the door for some opportunities in terms of harvesting some losses going forward.
Coulter, this is all really great, and we got tons of questions in, so I want to hit on some of these questions. Maybe before we do, just just remind everybody that VanEck does an awful lot to inform investors of what they own, try to let them know why they own it. So I very much encourage you, if you're interested in these topics, to visit our website, vaneck.com, and subscribe to some of our insights. You can kind of tailor your interests to your subscriptions and get the kind of content you want from VanEck. But we put out a lot of really good stuff on these spaces, particularly on the BDC side. So please, I encourage you to take a look. All right. You mentioned a few things, Coulter, throughout this segment on BDC. So let's stick with this topic, and we can jump around a little bit thereafter because we did get quite a few questions in. Let's start with something from RR. Any performance fees, or is only the management fee that I have to concern about? So I will answer very quickly. Yes, for BIZD, our BDC income ETF, the management fee is all that is charged by VanEck for its investment services. There are no performance fees, but it raises a bigger question because we report an awfully large net expense ratio, and that's a reporting requirement mandated by the SEC because these BDCs are investment companies, they're funds. So our ETF, BIZD, is a fund of funds. So there are these indirect expenses that are already reflected in the prices of the underlying BDCs, but we must report those in our prospectus expense table. So Coulter, why don't you dive into that briefly?
Yeah, absolutely. That's certainly one of the more common questions we get. Essentially, it's, people will pull up, our fund and other funds that invest in BDCs, and they'll see a sort of an eye-popping, double-digit expense ratio. But yeah, to your point, Brendan, VanEck and our product, we charge a 40 basis point management fee. But the bulk of that net expense ratio is coming from the underlying BDCs themselves. So even if you were to go out and buy a basket of BDCs and maintain that yourself, you would be paying that same sort of underlying BDC fee. And ultimately, as what Brandon mentioned, just a reporting requirement. Many of these BDCs have operating expenses, interest expense. They will oftentimes, many can be externally managed, so they may have incentive fees for the external manager as well that gets rolled up into that expense. But ultimately, that is all baked into the share price of those BDCs. And so when you're looking at the total returns of our fund and other BDCs themselves, you'll see that those fees are already incorporated into those returns.
Excellent, thank you. Eric asked a question: is BIZD a passive index ETF? Yes, it tracks an index offered by market vector indexes, and it is essentially beta for the BDC industry, so a market cap weighted index. So to be clear, it is not actively managed. It is an index ETF. Sticking with BDCs, you mentioned this, Coulter, you alluded to this, some of this dynamic going on in the market this year, particularly in the last several months. Tony asked a question: BIZD is down year to date, so there's negative returns. What will BIZD do in declining short-term rate next year? So two things I want you to touch on, because these are two dynamics for BDC investors that, if you're not reading up on the space, if you're not looking under the hood, may not be aware of. It has really two factors at play when it comes to return contributors. One, very importantly, is credit. So these are risky portfolios of loans direct to private companies, middle market companies. So there's credit risk involved. So any credit sentiment can impact prices of these BDCs. You alluded to that with First Brands, the price to book chart you had up on screen. But then, as you also indicated, most of the portfolio is floating rate loans. So it's predominantly floating rate, which has been great for BDCs in this rising rate environment we all lived through over the last several years. But that can also compress as yields come down. They'll float downward. So I think investors should be aware that yields can compress somewhat, but historically they've always been relatively elevated. So touch on those two dynamics, Coulter.
Yeah, certainly. Those are certainly the two main, sort of risk drivers, if you will, of BDCs, and what drives the price action for predominantly is the interest rate side of things. As floating rates come down, you could see some pressure from the income of these BDCs. But I would say by and large, we've sort of been in a Goldilocks period. The last couple of years, we've had very higher rates, which have resulted in higher income from these floating rate loans of these BDC portfolios. But I think also more crucially important is that we've had very strong credit. The credit fundamentals of these portfolio companies that are actually paying the interest on those loans has been very strong. But going forward, as rates come down, I think the interest rate side of things is a minor impact in terms of what might drive the price of these BDCs. I think many investors understand that these are floating rate loans, and as rates move down, they would expect to have some modest level of sort of compression in terms of income. But I think we would still sit in very attractive, income ranges of around 9-ish%, 10%. I think that the more important part, and I think what's driving most of the volatility recently, is sort of the sentiment around credit. Credit has remained very strong. Even credit spreads today on corporate debt, like high yield and the triple C's, is still relatively tight. And if we get to a credit event that might cause spreads to widen out, or more concern around credit, that would ultimately, I think, play a bigger role in volatility moving forward. So while the rate side of things, as rates come down a little bit, I think that's a little bit more easily to model out and easy to understand. It's the credit side of things that can kind of go from 0 to 100 sometimes, or even just the sentiment of people's awareness of what they view. Sometimes people can kind of see little credit events here and there, but I think that ultimately would be the bigger driver of volatility in these BDCs going forward, rather than just rates coming down a little bit.
Okay, perfect. So let's go back to mortgage REITs. It's such a fascinating space. So there's a few questions that have very similar narratives throughout them. So I'm going to jumble these all together. So bear with me. I'm going to take a stab at a little bit of this, and then Coulter, I want you to jump in and correct whatever I get wrong and add whatever I missed. But there's a few questions around mortgage REITs because they're high income products, so they pay high yields, but we've seen some price pressure on the underlying mortgage REITs, particularly over the last several years. Also, there's these dynamics of commercial real estate exposure, which has been very much timely and of concern to many investors, particularly through the pandemic and as we entered a kind of a new work from home hybrid model in the workforce. So, speaking about kind of performance drivers and what to expect from a total return perspective, historically, I would urge all income investors, whether you're investing in plain vanilla investment grade corporate debt, straight through to these high yielding segments of the market, to pay very close attention to your total returns over time. And that's, investing income and reinvesting dividends on ETFs or other equities. Because if you leave out that component, very often you're going to see negative returns from bond investments, if not flat returns. And that's no different for BDCs and then mortgage REITs, which this question is specific to. So if you think about a mortgage REIT, it's generating all of this income from primarily mortgage-backed securities or some other investments. Often they're leveraging up that exposure to provide and enhance those yields. But as rates rise, which they very much did in the earlier part of this decade, that can put pressure on these mortgage securities, the duration effect. So the prices would see some pressure, and essentially the book value of many of these mortgage REITs that were holding mostly exposure to these mortgage-backed securities, think bonds, essentially, you saw book value erosion through that rising rate period. So if you look specifically over the last 5 years, and frankly, if you go back to the inception of our ETF back in 2011, if you don't factor in the income return to your investment, you're going to see significant losses because, frankly, the price deterioration over rate cycles can happen. And because REITs have to pay out upwards of 98% or so of their income, there really isn't that organic book value accretion ability from these mortgage REITs, and that's why they're implementing leverage and things of that nature. So it is very much an income vehicle, and it is very susceptible to liquidity squeezes and rate dynamics. And I think Coulter made a very good point about all that. But again, if you look at the total return versus the price return of our ETF or any index in this space, you're going to see very different returns. Ultimately, as an investor, a shareholder, you're getting all of that income and your total return is elevated. But I hope that touches on that topic of price versus total return and kind of what has driven some of the return dynamics over the last several years. Coulter, anything else you'd add to that?
Yeah, I would just touch briefly on sort of the side of the question that touches on sort of commercial exposure here over the last couple of years. So I know that has been a big topic, as we sort of went through the pandemic and shifted sort of the way we work. That had an impact on commercial real estate, particularly office real estate. But I think much of that. So I think that played a big role in sort of pressures within the mortgage REIT market. Obviously, as I mentioned earlier, some have some exposure to commercial mortgages, others have zero. Some focus on it, some do not. So you can see varying profiles and volatility around the different types of REITs, depending if they owned or didn't own any commercial real estate loans. But I think going forward, I think many people are sort of, looking at this as sort of, we're moving back towards more of a normalized, environment. Many people are oftentimes, return to the office for the most part. And I think more importantly, the broader commercial real estate, which often touches into, industrials and other sort of material companies. I think that, particularly over the last year or two, has been very strong. I think you're seeing more investment in sort of that type of, commercial, real estate and investment than you have almost any other time, as it's tied in with this sort of, theme of AI and data center build out. You're seeing lots of investment there, and so I would say that, while there could still be some, concerns around some office buildings, but by and large, the broader commercial, space, I think, is really sort of having a little bit of a tailwind, at least certain areas of it, and so that could, certainly be worth monitoring as well.
Excellent. This is a theoretical question, and I don't have an answer, maybe just an observation. Richard asked, would mortgage agencies going public affect the price? And this is specific to Mort and mortgage REITs. And I think that's tied to, this discussion of privatizing, Fannie Mae, Freddie Mac, and institutions like that. Again, that's somewhat theoretical. Who knows if anything like that would happen? But of course, I think it would have implications. So some of the mortgage REITs held and some of the largest mortgage REITs in the portfolio are focused predominantly on agency-backed securities, mostly residential. And because agency-backed mortgage securities have the full faith kind of guarantee behind them, by being, agencies of the federal government, the credit risk is very minimal with agency-backed securities. And as such, these mortgage REITs have to or choose to employ larger amounts of leverage. So their leverage profile is much more significant, to increase the generally lower yields you get, the spreads you get from lower credit risk agency-backed mortgages. So if they were to privatize, that would probably change the dynamics. If there was no longer that full faith and credit backing of these securities, that would probably change the business models of many of these mortgage REITs. There are plenty of mortgage REITs that use less leverage, and they seek out yield by taking on more credit risk and going with non-agency backed mortgage securities or other methods. So it's kind of hard to answer, but yeah, I think it's in theory it would just kind of change the game to some degree if there was no full faith and credit, and that applies across ABS markets, generally speaking. Coulter, maybe I'll put this last one with you. If you don't have a view, that is okay. But Lyle is asking basically about yield curves, and you showed the varying steepness of yield curves historically. We went from a period where we had an extremely steep yield curve for the better part of 2009 straight through to the later part of last decade. And we don't necessarily expect without seeing some sort of financial calamity, we don't expect zero interest rate policy anytime soon. So I guess the question from Lyle is, can that dynamic of that steep yield curve and the net interest margins that you discussed come back? And if not, is it more just a muted outlook for net interest margins?
Yeah, that's a great question, and I think you're right. I wouldn't anticipate us seeing zero short-term rates like we have historically, at least not anytime soon. But I would also say that, where we sit today at a very flat rate, the short-term rates of about 4% versus long-term of about 4.5 or so, the spread there is very tight. So even if we come down a little bit, I think, from a relative perspective of very tight flat curve now, which is what the mortgage REITs industry has been dealing with over the last couple of years, even a modest 1% lower short-term rate, would have a pretty big impact on relative change of their net interest margins going forward. So you're right. As we may not see, half basis point or half percentage point, short-term rates and massive 3% spreads, anytime in the next year or two. But I would say that, we're at a very tight spot now in terms of the spread between short and long-term, maturities, that any sort of, meaningful or modest, widening of that spread would have a pretty supportive impact on the mortgage REIT business model in general. So I don't think it'll take a whole lot to be helpful.
Got it. Thanks, Coulter. And then the last question came in. This is kind of a developing story, so we don't really have a take or an answer right now. We were monitoring the situation, but specific to BIZD, Blue Owl Capital, a very large player in the private credit space. They have various vehicles offering private credit exposure. And OBDC, their publicly traded BDC, is a holding in BIZD. They had announced plans to merge one of their non-traded BDCs into OBDC, and that was met with some significant pushback from the market and some press. It looks to me like they called off that merger, if these news reports are accurate, which was a little bit of news to me. So something developing in the space. So again, the question is, has the recent news with Blue Owl Capital been discussed with the VanEck team? Of course, we're monitoring that. We're well aware of that situation. It's kind of fascinating. The only thing I'd say more broadly to the BDC market than specific to Blue Owl would be, there are various types of business development companies. BDCs, business development companies, are very strictly regulated investment vehicles. They are a specifically laid out structure that's regulated by the 1940 Act, similarly to ETFs, similarly to other closed-end fund vehicles and open-end mutual funds. So they're heavily regulated, but they can come in various forms. One would be publicly traded, which is what we've discussed today and what we hold in our BIZD ETF. But there are also non-traded business development companies, and those tend to be less liquid, of course. So they're not traded on an exchange, and they have direct kind of investment agreements and arrangements between investors with certain investor qualifications, tend to be high net worth, high minimum type of investments. And often there's a lack of liquidity. And so when non-traded BDCs are launched, oftentimes there's a plan, whether it's formal or informal, to provide liquidity to investors. And oftentimes the path to market is to IPO and become a publicly traded BDC. And then those investors that have been tied up can then sell shares on the exchange if they choose. Sometimes they'll merge, and that was the case of what we're discussing here from Blue Owl, that has been in the headlines as of late. And in some other cases, they'll dissolve the BDC over time and draw down that fund. So it's a unique space, and I don't have a take on that specific situation, but that seems to be developing in real time. Coulter, anything you'd add on that topic?
Yeah, I would just say, I mean, I think to your point, this type of liquidity plan is typically not, it's not abnormal for these sort of non-traded BDCs. So I think that's one thing. Perhaps the timing of it was sort of the volatility around the public space is sort of what's driving a lot of this rhetoric. But I think importantly highlights the fact that liquidity is certainly something to be aware of, and at least when it comes to the publicly traded BDCs, liquidity can be sort of a double-edged sword. It can provide you intraday liquidity in and out, but also it acts as price discovery. So you are seeing real-time, prices of these BDCs as per the market judges and the buys and the sells. So, I think it can be, it highlights an important aspect that, these publicly traded BDCs, while they might trade at, discounts to NAV at certain times, ultimately it does reflect sort of, a pricing mechanism for these sort of, types of vehicles that provide exposure to direct loans. And so, it can be double-edged sword at times, but at least it gives you, liquidity, and it gives you an accurate sort of pricing mechanism dictated by the market.
All right, Coulter. That was probably some of the highest quantity of questions I've gotten on a webinar in quite a bit of time. So clearly it's an interesting topic, very dynamic in terms of opportunity, but also risks. So we always try to highlight that anything with yields in excess of 10% comes with some level of risk, right? And those risks vary, but we do like to point that out to investors. So we really appreciate your insight, keeping us apprised of the dynamics in the marketplace, opportunities moving forward. These are our two highest yielding ETFs, if we didn't point that out at the onset. So very interesting and compelling investment opportunity, but one that needs to be considered as part of, a diversified portfolio. So with that being said, a reminder that you can visit our website, vaneck.com/subscribe to receive regular content. And that concludes our today's webinar. So thank you all for joining.